We are just 5 minutes away from the latest US jobs number. Economists forecasting between 205 and 210,000 jobs to have been added in March. Unemployment, that's expected to hold at 4.9%, but it will be the average hourly wages that will probably be the most closely scrutinised after dropping 0.1% in February. That really overshadowed the positive number we saw in February of 242,000. Expectations are for a 0.3% rise in hourly wages for March. Now, of interest also, in 7 of the past 8 years, the government's first print of March data has significantly missed the mark, falling below the consensus of economists by, well, quite a wide margin. We'll be with us to discuss what to expect, how to trade the numbers, and what it means for the US economy overall is Alex Little. He's from Phoenix Partners and joins us now. Thanks very much for coming in.
Thank you.
Let's address the fact that actually March is a month when we've seen data miss.
It is. There are always cyclical patterns, as you've stated. It tends to be a bit of a miss, but of the last 6 months, we're looking at 4 of those pretty strong numbers, so averaging out around 235 usually for the non-farm number. So all in all, yeah, there's an element of truth to that, but wouldn't want to conjure any speculation just yet.
Interestingly, the number expected for economists has changed over the week. Where are you sitting?
So general consensus is around the 205 mark, as you say, 205 to 210. I think it's fair to say that the Fed are happy if we're above 200. If we sit within 20, 30,000 of that, then we could maybe see not the volatility that we've seen previously. Expectations are probably pretty much spot on, so somewhere just over the 200 mark would probably be fair game.
Yeah, and that's when we will see the movements, isn't it? If we're under the 200 mark, which has been the average last couple of months, that's when we're going to see real moves in the dollar, equally the other side as well. Yeah,
exactly, and often it is risk related as well as dollar related. At the start of the year, we've seen a lot of risk moves with China, so whether or not it'll be a risk move as opposed to the dollar will be interesting, but it's fair to say a good number, 210 and up, you'd probably expect a bit of dollar strength.
Well, let's look at the dollar then. First of all, let's look at cable, which is what we've got here. This is a daily chart. Obviously, when the numbers come out, we'll look in more depth at it. What are you looking for in terms of the levels on cable at the moment?
So we've been sitting in a range of sort of the 140.50 area to 145 in the last couple of weeks. I think 145's decent resistance. We've pulled off a lot today. As you can see, trading around 143 at the moment. I'd say all in all we'd need a pretty big variation from 205 210 to see any big moves. But when you've seen a lot of a move during a day, you perhaps wonder whether or not the move has already occurred. But euro-dollar's trading very differently, so there could be a bit of a correlation change between
Well, let's
the two.
take a look then at a euro-dollar, because that really is primarily the trade, simply because of the divergence we're seeing in central bank policy at the moment. So euro-dollar currently trading at what, 142, 142.25 at the moment?
Yeah, and I think it's fair to say that's probably a little higher than a lot would expect at the moment. It's much towards the top of the range. With a lot of policy action that you've seen from Mario Draghi of late, obviously starting off in December and then more recently extending QE, decreasing all the 3 rates. Eurodollar has surprised a few people, so there's definitely resistance up at around the 115 area.
Yes, the highs we saw back there. You can see that the highs we saw back there in October last year. Yeah,
exactly. And we shot comfortably above that back in August on news of China. But I think it's fair to say the support areas are sort of few and far between to a certain extent. So 107, 115, I know it's a large range, but it's a tough one to call. But the upside's probably a little bit more limited.
Obviously, we were talking this morning in Charting Markets about the volatility surrounding non-farm payrolls, and this is one thing that traders, new traders especially, need to recognise, isn't it?
Yeah, no, definitely. Non-farm payrolls used to be something that would see 100, 200 point swings pretty quickly, around the 10, 15 minute gap in and before. We haven't seen that as much of late. So yes, there's always the volatility, but maybe there haven't been the violent swings that we maybe used to get a sort of a year or two ago.
Okay, let's look. I'm just going to go over some of the other markets away from the FX ahead of the non-farm payrolls. We're just a few seconds away from that at the moment because, of course, we are also, just an hour away from the open of the US market. So there's Wall Street cash for you. We've got US 500 as well, all currently trading down around 1/3%. They're following on from declines in Asia overnight as well, and that negative start to the session here in Europe too. So we are now expecting those US numbers out as they're crossing the terminal as we speak. Non-farm payrolls 215,000, so better than expected. Participation rate is 63%. We've got unemployment at 5% against 4.9% expected there. Just great going through these for you. We've got, as expected, average hourly wages. That's the one we were looking for. It's up 0.3%, in line with expectations. That, of course, followed that drop we saw in February of 0.1% there. And if we go through some of the jobs, private sector jobs up 195,000, really bang in line there. Government jobs all but in line as well. So we really are seeing numbers coming in as expected. So March non-farm payrolls rising by 215,000, a real solid increase. And of course it is those wages, that rebound in wages that people were really watching out for there. What do you make of the numbers then, Alex?
So 215, a little higher than expected. Probably on face value, not enough to shake markets too much, I wouldn't have thought. Certainly the wages is interesting, as you say, a bit of a recovery on February, so that will be welcomed by the Fed. So I think we can see at the moment.
Yeah, that's a second by second chart of the euro dollar. I mean, you say not much movement. We did see an immediate drop, but it has pulled back.
Yeah. So often the initial reaction will be recouped, if you like, as markets kind of settle in and traders and investors take note of the move. The wages will be welcomed, so there's a potential for dollar strength on that side. We're not seeing it just yet at the moment. 215, though, I don't think is probably a big enough big enough on the upside,
yeah.
Big enough surprise to really shake things too much. Unemployment level, that's interesting, 5% in and around there. It's not huge news, but I mean, I think the Fed are pretty happy around 5%. Most economists have that pretty much as full employment, as we've seen recently from comments from Fed's Williams and Lockhart, and just to name a couple.
I mean, that's an interesting point you bring there. While we wait for these markets to settle, a reminder, non-farm payrolls 215,000, unemployment 5%. We've got average hourly wages up 0.3%. Another thing we'll get to in a moment is participation rate, 63%. But I want to pick up on something you said there, Alex, about these other FOMC members, because the talk this week's all been about Yellen. But actually there's a real, not a split, but we've had a different rhetoric between some of these FOMC members at the moment.
Definitely, and as I say, Williams and Lockhart, just to name a couple, last week were very bullish. At the end of the day, we've got to accept that whilst there are global headwinds from China, general growth and anything similar, it is fair to say that, as we've seen in sterling dollar, we saw a massive recoup up to the 144, almost 145 area recently. That was purely on Yellen having some fairly dovish comments on Tuesday.
Well, we're looking at sterling dollar now and the reaction to those numbers. You can see that that big red candle there, that is 130 the minute those numbers came out. And we did see the fall down to that 142.70 level, which is providing some support at the moment.
Yeah, I think it's fair to say that the support probably doesn't come in until the 40-50 region. So because we saw such a rise in sterling dollar earlier in the week, this is kind of calibrating back a little bit. But it's certainly those earnings figures and, yeah, a slightly better headline number.
It'd be interesting to actually, let's just check on one of the other currency pairs at the moment. You can see the bottom of your screen, keep an eye on what's happening on the equity markets, because I want to check in on a pound euro, simply because obviously it's not a dollar pair, but because of what we're seeing in terms of the central banks and of course the importance of the trade partnerships between these countries, any movements there, not as much obviously as you would get euro dollar and cable, but we have seen a little bit of movement there.
We certainly have, and trading around 125, I can see there we've almost tried to test it, not quite. It's under pressure. The euro's performing incredibly well. Sterling's under pressure. It's not just the sterling dollar taking the dollar element out of that trade, but it's also bearing in mind other factors, political factors, Brexit. There's a lot of pressure on the pound, and with the euro standing quite strong, that's why we've seen a lot of weakness in sterling euro. It's more the fundamentals probably than the technicals in this case.
I mentioned the participation rate, 63%. A lot of focus has been on this recently because it's been improving slowly, but it's still, I mean, nowhere near where Janet Yellen and the Fed would like it to be.
It is, but I think it's kind of a one step at a time sort of thing. You know, the headline unemployment level is pretty good, I think, from the Fed's perspective. We've seen, you know, hourly earnings a little bit better than we saw last month. Then non-farms, job creation good. So I think, you know, one, participation rate will get there, but I guess having everything in line, it's not an ideal world. So I guess they will get there. So I think it's the next step for them for sure. But we can see that I think their euro dollar's trading, a little bit lower now. So we're seeing that dollar strength sort of sink in as markets take a few minutes. Yeah,
and this is what we mean about traders with you new to the markets, that volatility straight away. You know, you have to be so careful with that. Now, last time you were in mid-February, I think it was, you were asking for more transparency from the Fed. Did you get that this week? Or is it just
sort of. I think, I mean, it's not surprising that Janet Yellen's keeping her cards relatively close to her chest, so to speak. There are still potential for 2 rate hikes. April is probably, it's fair to say, there's a very low probability there. June is the first one people will be looking at. Any dovish comments is where you see the rise in sterling dollar, also in euro dollar. But I think, as you say, the divergence within the Fed, there are plenty of people coming out, as we said, Williams and Lockhart, that are kind of balancing things out at the moment. So I think there's enough transparency, but I think, as any central banker will say, there's only so much that needs to go to the press, so to speak.
Okay, so a reminder what we saw in terms of those numbers. 215,000 is the headline number. Some could say the average hourly wages is the headline number. That was up 0.3%. Unemployment up at 5%. Their participation rate also coming into play at 63%. So those are the numbers that we're getting in at the moment. I was looking for some revisions, but I haven't seen any crossing the terminal at the moment. If I see them, I will bring them to you as well. There is one other thing I wanted to bring up, Alex, and that is the focus. Before the numbers came out, we were talking about the focus, how it's changed to average hourly wages rather than the top line number. And this is because that focus is now on inflation, so much more on inflation expectations. For you, with the US economy at the moment, how do you see it? How do you see it playing into trading the forex markets?
Well, it's crucial. Inflation is crucial. So I think whilst we sit here and talk about non-farms, it is inflation moving forward. It's what Yellen cited just a couple of days ago. Williams and Lockhart in their same speeches last week, they were saying that they would expect inflation to return start to push higher in the second half of the year. We're probably not going to see it in the next few months. If we do, then there's a pretty good argument for further dollar strength. Obviously, the trend in sterling dollar in particular is very much down, albeit a little bit range bound in the last week or two. So yeah, the market will react heavily to those fundamentals. If inflation picks up and doesn't in the UK, which I think is fair to say, Carney has been pretty modest and pretty measured in his approach, in that we're probably not going to see an uplift at the moment. You know, commodity markets and oil do come into it as well. So any uplift in inflation will see quite significant dollar strength. Yeah,
I mean, so the moves we've seen, the oil market, the gold market. Interestingly, when we're looking at the central bank policies, we've just mentioned euro, pound and dollar, but of course so much more comes into it. Just today we had the Tankan survey, really disappointing. Then we had Chinese manufacturing, surprising to the upside, the best in 9 months. And so this policy stimulus really playing into these trades.
Yeah, for sure, and everyone's focusing on China. Has to be taken with a pinch of salt, just one reading being particularly good, I think, to a certain extent. The pressure is still, you know, growth, GDP is still a bit of a concern, but at the same time, that's purely because China has slowed in the last 9-12 months. I don't think maybe it should have been a shock to markets that it perhaps was last summer. But as with anything, things have to filter through to markets, and that goes into price action. So oil being low and various commodities being under pressure is heavily linked to inflation, and thus, you know, any movement in the dollar.
What for you is the key forex trade at the moment?
So in sterling dollar, it's whether or not we are going to see those lows push back into the 130s. It's fair to say that we've pushed back a little bit into the 142 region where we sit at the moment. That's probably purely on Yellen early in the week. So there's still downside pressure in sterling dollar. How much the Brexit and speculation and political uncertainty feeds through will be the play probably on sterling specifically. We're still a couple of months away from the idea of a potential Brexit. The polls are probably starting to suggest it might be a closer run thing than maybe we first thought. As we saw with the Scottish referendum, there are similarities there if you look historically, which is in many senses all we can do. Then yes, there is a chance that weighs quite heavily on sterling.
Okay, thank you very much. It is definitely currency watching here. A reminder of the headlines we've had out. 215,000 jobs added to the US jobs market in March. Unemployment up to 5%. We have been expecting to hold steady at 4.9%. Importantly, average hourly wages up 0.3% there. We've also had a revision to the February one. It's just a slight revision up from 242,000 to 245,000 as well. So painting a very positive picture for the US labour market as well, and we've seen what that has done to the markets. Have a quick look in terms of the equity markets. I know they've been flashing along the bottom of your screen while we've been talking. The US markets, we've got Wall Street and just down around 0.5% there, just an hour and 45 minutes before the US Open there. Those are the live prices you'll find on the IG platform. In terms of what it's doing for the European markets, well, it's been a lower session throughout the day so far for Europe. We've got FTSE 100 down 1.4%. Falls of over 2.5% for Germany and France at the moment. Quick check of the currency markets as well. That's what we've been discussing. That's what's been happening. We've got cable down 0.5% at the moment. We've got euro dollar up around 0.4%. There you go. Those are the three major dollar crosses we've been keeping a close eye on. Before I go, there is one stock though I do want to mention because of the US Open. It is an all-session stock here at IG is BlackBerry. It is one to watch today. We are down at $7.5, down more than 6% after revenue missed estimates. $464 million, a $238 million net loss. That was in the fourth quarter. This after adjustments, excluding restructuring and acquisitions. Loss per share, though, was less than estimates. It was down 0.3%. We have been looking for a loss around 10 cents there, but that not enough to boost the struggling tech company. BlackBerry, of course, been really hard hit in recent years. Sales dropping, developers, including Facebook, really ending support for its devices. And the company has shifted much of its focus to software development and services. So this, of course, an area of the business BlackBerry expects to grow by, it says, as much as 30%. Now, the company at its peak accounted for a fifth of all smartphone sales. Can you believe that? I can remember those times. It's seen its shares collapse from a peak of over $227 in 2007 to just, well, $7.50 today. We're down 15% year to date, 17% over the past 12 months. And sell-side analysts that track BlackBerry, well, they've got a target price. Well, they did have a target price of $7.80, and say we've smashed through that at the moment. So do keep a very close eye on that for the rest of the trading day. And of course, I say all session stock here at IG means you can trade it out of the normal trading hours when those numbers came out. So that's a BlackBerry there. Non-farm payrolls then coming just ahead of expectations. Unemployment also better, but average hourly wages coming in as expected, up 0.3%. That's it from us for now. We'll be back on Monday morning at 7:30. Do look out for our week ahead. We'll be looking at all the companies and the economic data to watch out for over the next 7 days.